Welcome to Alternative Investments Chat,
where we demystify the world of alternative investments and financing for entrepreneurs and investors alike.
With these discussions, we hope you're more empowered to unlock opportunities in your business or portfolio. I'm Erin.
And I'm Erica. Let's get started. Hello, and welcome back to another episode of Alternative Investments Chat. Today, we're coming at you from beyond the grave.
Ooh.
Okay, no, obviously not, but we're going to talk about one thing in life that is most definitely certain, unfortunately, and that is death, right? So now, what does death have to do with investments? You may be asking yourself. I know I sure did when we got this topic, but enter life settlements.
Yeah, exactly. The life settlement industry is actually growing and has the potential to really take off in the coming years, which could be exciting for fellow investors.
Right.
In fact, the annual gross market potential for life settlements in the U.S. between 2019 and 2028 has been estimated to be at over $200 billion with a B dollars.
Wow. Okay.
So today we're going to learn about life settlements and why demand is rising.
Okay.
So as usual, let's start by defining our topic. So a life settlement, good place to start, right? A life settlement is when someone decides that they want to get rid of their life insurance policy, and instead of canceling it, they actually sell it to a third-party investor for cash money.
Okay.
So someone might want to cancel their life insurance policy for a myriad of reasons. One, maybe they can't afford to pay the premium anymore. They don't need the coverage, or they want to or need to liquidate some assets, need some extra cash flow coming through. Selling a policy can often be more attractive than just canceling it straight up, because you can usually get more money for the policy by selling it as opposed to canceling it, although it is less than the death benefit. Right.
Got it. But if you just stop paying, that's all your money wasted.
Exactly. Yes. In fact, in a 2025 life settlements industry report from Harbor Life Settlements, that tells us that selling often brings 4 times the value the policyholder would have been able to recoup just from canceling it alone. Okay. So the investor who purchases the settlement now pays the premiums. And after the policyholder passes, they also get to collect the death benefit.
Okay. So obviously, I think we should address the very huge elephant in the room here. So basically, you just told me that the investor is just waiting for that policyholder to die? Kick the bucket?
Yeah. Lots of, any other idioms you want to give me?
Yeah, I know.
But in a morbid sense, yes.
Okay.
But what's nice for the policyholder is that while they're living, if they need to utilize that cash, they can.
Because they've sold it.
They've sold it. And that money typically, or not typically, would not have come to them when they were living. If they had not had sold it, it would, be passed on to whoever their beneficiaries are after they pass.
Yeah.
So that is a benefit for that person who sells it.
Okay.
But a good way to kind of think about this is that life settlements are kind of like the opposite of life insurance. In life insurance, the life insurance company wants you to live as long as you possibly can.
Absolutely. They want you to keep paying.
Right. If you could live forever, that'd be really great for a life insurance, company, because every month you get to make these payments to them and they don't have to pay out anything. They're just collecting that money and moving on with their lives. Right.
Yeah.
But for life settlements, the opposite is true, because the investor is covering the insurance payments or premiums each month, and obviously with each payment that reduces the overall potential for profit. So yes, to answer your question. And this conversation, as you can tell, requires a little bit of nuance because it deals with death. And if you have experienced death in your life, you know how difficult that is personally, right?
Yeah.
However, if we're just strictly speaking about the numbers and we remove the emotion from it, there it is. That's the truth.
Okay, I feel you. I'm getting on board, just so you're aware. And I am very comfortable with the topic of death and dying. And I think we've kind of mentioned this in past episodes, but for those of our listeners who don't know, I actually have a minor in forensics. And so just in case anyone wants to get rid of a body. DM me below. Anyway, no, I'm totally joking. Don't. I mean, I'm always help.
If you come back next week and Erica's not here anymore, you'll know she's in jail.
Yeah, no. So, yeah, I'm totally joking. But so who's in the market to purchase these life settlements anyway? So let's talk about that. So as you can probably predict, life settlements are mainly for senior age people, 65 and above. I think that's really rude that we call them seniors, but 65 years
It's like senior in high school. Cool.
Yeah, exactly.
Seniors in high school were the coolest kids there. So you get to be a senior again.
I'm getting to that senior age sooner than later. So now I'm going to get really upset when people start calling people seniors, okay? Remember when we were younger and we used to think that like 40-year-olds were old? Well, I'm old now, so how about that? Well, I'll just leave it at that. So anyway, so when you're buying these policies, it typically takes 2 to 4 months for an application to funding, depending on the policy and the state regulations. You know, FINRA, our best friend, needs to make sure that they get in there and you're following all the rules and regulations.
Right, of course.
So for example, let's say that someone is 70 years old and owns a 30,000, I'm sorry, not 30, that's not a lot, 300,000 universal life insurance policy. So they're retired, they're no longer working, and they might not actually need the coverage. So plus the premiums could become a financial burden, like you mentioned earlier. Like you don't have any income coming in, it's kind of hard to push them out. So the surrender value of this policy, aka the amount they'd get by turning it back to the issuer, is roughly $20,000. So you have 300 is the policy, and you're only getting $20,000. Okay. Yep. So instead, they actually explore a life settlement and sell their policy to an investor for, let's say, $65,000. Okay?
It's better than 20.
So they get exactly. They get such a much larger sum of money to use during their retirement. They can actually take that $65,000, use it, and the investor takes over, paying the premium, like you mentioned, and eventually will receive that $300,000 death benefit when the time comes, when the light extenuates from the lovely person.
It's time
to pass on.
Move along.
Yes. So, I mean, look at the numbers there.
Yeah. The numbers speak for themselves for sure. And, like you mentioned, people explore life settlements for a lot of different reasons, but it is usually about needing cash for retirement, healthcare, or they need to stop paying those expensive premiums because income is a challenge. Yeah. Most life insurance policies never pay a death benefit because they have been lapsed or surrendered, a lot of them, meaning that policy holders leave billions on the table. Again, billions with a B. So every year, about $200 billion in life insurance policies are either lapsed or surrendered. Crazy.
That's a crazy amount.
Crazy. And of course, right, the life insurance companies, yum, 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 yum. Eating up all their money. Yay.
Some more.
Yeah,
Bye.
they're
Thanks,
happy.
bye. Yeah.
But not so good for the policyholder, right?
No.
And the silver wave is upon us. And what does that mean? Well, lots of...
Do I need to get my hair done? Is it silver?
Not yet, but I will let you know. But what this means is that roughly 10,000 Americans turn 65 every single day. So we have an increasing amount of seniors in our population now. In fact, thanks to the miracles of the modern age, people are living to be older than ever in American history. And meanwhile, if you've turned on the news recently, you know that there is a concern about Social Security and Medicare funding, which many people rely on to be able to sustain them throughout their retirement. Yeah. So many seniors are facing a more difficult and longer retirement because they are living to be longer. Yeah. And they're trying to make their money stretch for as long as they are so lucky to live. And, that's not cheap.
No, not even cheap in the slightest. And everything keeps going up, which probably makes it worse for them. So I think about the seniors who keep having to work, like when we, they have to get a part-time job to cover living costs and when they should be enjoying, like when I go out and I see like someone who potentially could be my grandmother's age and they're working at a grocery store and, sometimes it's for social purposes. I'm not saying that every single person does this, but like, most of the time it's because they can't afford
Yeah,
to survive.
They need more money.
Yeah. So I can understand. So potentially a life settlement could help pay for the costly medical treatments, in-home care, or anything else that an aging person needs to fund, which, again, there's so much more happening these days. So if a retiree needs money, and why aren't life settlements more popular?
Yeah, that's a great question.
Well, according to the same market industry report published at Harbor Life Settlements, it turns out that there's actually just a lack of awareness and education really is the biggest issue. So a 2010 survey revealed that of the seniors that participated, 90% stated that they would consider selling their life insurance policy if they'd known that that was an option. Okay. So it can get it can be a little bit of a lengthy process. So again, you have to think about that. Sometimes if you need the money right then and there, it might not be, because settlements often take 2 to 4 months. So say, again, if you need the cash right then, it might not be the option. But additionally, life insurance companies can be really persuasive.
Yeah.
Of course. So they want to keep people in their policies, as long as they possibly can. So they'll try to convince that policyholder to stay as long as absolutely possible.
Right.
They don't want to sell. They don't want you selling it off, because that means less money for them.
Exactly. Again, they want that. They want that money coming in every month. That benefits them for sure.
Yeah.
So, if someone wanted to get a life settlement, what does that mean for the policyholder and the actual investor who purchases it? Once a policyholder decides to sell, brokers or financial advisors can match them with buyers. This could be an individual accredited investor, this could be an investment fund, or institutional buyers. So there's lots of different people, individuals and groups that might be interested in purchasing a policy. The policy has to go through an actual valuation process, and this depends on a few factors here. We have the death benefit amount, so the amount that's paid out, the life expectancy of the person who is insured, and this is determined by actuarial analysis and medical underwriting. So you're kind of like looking at the probability of how long is this person's life going to be. And additionally, the premium costs that must be paid on that policy until the policy matures, or AKA when that person passes on. Once the settlement is sold and ownership is transferred over to the investor, the policyholder walks away with a lump sum of cash. Woohoo! Yay! But as the investor, not quite yet, your profit is determined by the death benefit minus the purchase price, minus the total amount of premiums that you have paid. Hopefully, that will result in a lump sum of cash for you too when it's time.
So we've covered why the policy owners would be interested in life settlements, but what about the investor? So again, as the person selling it, you're getting some chunks. So what does the investor get? Because we got to always think of the other side. So one, it's an correlated asset.
Right.
All these assets that we talk about on our podcast, the majority of them are uncorrelated assets. So meaning it could be a good option for portfolio diversification, our favorite word, besides due diligence, diversification. This is basically the why of all alternative investments, right? To diversify. We've got a guaranteed death benefit payment for investors. So when the deal is made, you will be paid out through the death benefit. Words are hard, remember. Now, don't get this confused with guarantee, that G word that we never, we don't talk about. There's no guaranteed profit here. So remember the little math equation that you just did? Profit depends on the cash outflow too. So, however, people like knowing exactly how much they're going to be getting on a death benefit check. Okay, so that's the
something
guaranteed.
to look forward to, right? You know, and you can kind of keep track of the math.
You're like, okay, I paid this much, so I should be getting this much back. I paid this much. It's kind of like when you're paying off debt. You're like, okay, this much went to the principal.
Right,
this much
exactly.
went to, and you can kind of guess when you can pay it off. Now it's just reverse how much you're going to get, right? Another, great thing for investors is it's an attractive return. So life settlements can potentially they offer potentially high returns. Depends on
what happens
when the person passes. So a paper published in the Journal of Risk and Insurance in 2015 revealed that over the period of 1993 to 2009, life insurance settlements performed an average of 3.5% higher than the S&P 500. So there's that to look forward for investors. Also, the last thing that they have to look forward to is the potential for increased demand.
Right.
So the so-called silver wave, again, not referring to my hair, is leading to an unprecedented high percentage of elderly people in America's population.
Yep.
Okay. Again, they're living longer, so there's more people there. This could mean that an increase in people pursuing life settlements in the coming year, because life is getting hard and we might have to sell off some stuff to keep sustaining just until the end.
Yeah.
Sucks to say it, but like that's how it is. You know?
Yeah. We all know it's going to happen, right?
Yeah.
So now we know that life settlements are famously shaped by mortality risk, right? Investor returns depend on how long the insured person lives, and if they live longer than expected, returns decline because premiums continue to accumulate, eating into your profit there. So there's something else that I left out about our little profit equation. Sorry. Taxes.
Oh, dang it.
Yeah.
The other thing we can always guarantee, death and taxes.
Exactly. They come for us all. But when the death benefit is collected, the payout is taxable income to you, the investor.
Okay.
So let's take our equation earlier, death benefit minus the purchase price minus the total premiums paid. That gives us our taxable profit, okay? For the individual investor, profits are generally taxed as ordinary income, not capital gains.
Okay.
And you are most familiar with ordinary income tax because this is the tax that comes out of your paycheck.
Right.
So every time you get that paycheck and you go, oh my God, why?
They took all my money in taxes.
Yeah,
I'm so broke.
Exactly. That's the ordinary income tax coming to get you. Capital gains tax actually applies to profits from stocks, real estate, etc., and it can only be applied to the gain. So we're looking at sales price minus the purchase price. That has to do with capital gains tax. Sorry for all the math today. Lots of math. But for funds, so remember how I mentioned that it could be an individual investor, but it could also be a fund that buys up a bunch of these. Taxation varies depending on the fund structure, so look out for that.
Okay.
States might also have their individual taxes too. Yay, taxes!
Whatever.
Said no one ever.
No. My face says it all, right? Okay. That's right, I guess. Whatever. Okay. The tax rate on an ordinary income varies depending on your individual taxable income. Okay. We're going to get into a little bit more math here, guys. Sorry about this.
Not over yet.
Not over. So there are actually 7 federal tax brackets ranging from 10 to 37%. So let's look at an example. Again, this has to go back into the income. Okay. So death benefits. So the policy payout, let's say you've got $1 million.
Okay.
Investor purchase price. So what you paid to buy the policy, $400,000.
Okay.
Premium paid over the years, $100,000.
Okay.
Okay. So the total cost basis, purchase plus premiums, you're looking at $500,000, $500,000.
$500,000.
So when the insured person passes away, RIP, the insurance company pays you $1 million.
Yes.
So using our equation, we can calculate the profit before taxes, which comes to $500,000.
Yes.
So now let's say you fall into the 32% tax bracket. So after taxes, you're accounted for, you will actually end up with a net profit of $340,000.
That sounds like a good payout.
I wouldn't mind it.
If I got a little payout of $340,000, that'd be nice. I'd take it.
Me too. Don't worry.
Yeah. Well, so let's discuss some of the risks and challenges that investors might face if they were to walk down this investment path.
Okay.
As mentioned, one of the biggest risks is life expectancy or longevity risk. If a person lives much longer than expected, paying monthly premiums eats into those profits. And sometimes it can look like someone is getting ready to depart the earth. And then they say JK, and their
all
health
is healed.
Yep, their health turns a corner, and they end up getting a bunch of extra years. I'm speaking from personal experience with that
I know
one.
Exactly who you're talking about.
Yep, my grandma was like, nope, I'm not going, and she did it.
Nope.
So surprise to all of us. But that is like a blessing for the family, right? It was certainly a blessing for us. But as the investor,
they're like, come on, lady.
Yeah, exactly.
Kick the bucket already.
Get a move on. Yeah, I hate to say it, but it's true. Yeah. And another thing to consider is illiquidity. As an investor, you're pretty much locked in until the policyholder passes. So what does this mean? Well, your capital could be tied up for 5 to 15 years, depending on what's going on with that person. Yeah. What are some other risks that you can share with our listeners?
No problem. You know, I've got a whole list of them for you. So here's one that's pretty obvious, but still it's always worth mentioning. As the investor, you're responsible for making the continuous premium payments.
Right.
So missing payments could actually cause the policy to lapse, again, meaning that you would lose the entire investment. Yeah. So, you know, you already put some money into it and then you forget to pay the premium.
Bummer, dude.
Like, there she go. Okay.
Big
so
bummer.
when taking on an investment like this, you want to be confident that you can make those consistent payments in order to take home, hopefully, a sizable profit.
Right.
Another risk is there's the moral and ethical concern with the investment type as well. Again, it is kind of pulls at people's heartstrings, which I fully understand. So some people may not feel comfortable knowing that their profit is actually dependent on someone else's death. Yeah. Which is completely, I think, understandable. Right. Okay. So
no judgment.
No, not at all. Though this is more of a potential challenge than a financial risk, it can still affect your investor morale and something to give thought to. Again, we have an episode about investing with emotions, so tune into that one because this could be part of it. Like if you're investing with all your emotions, you might miss out on this one, but that's okay. We don't really blame you that much, I think.
No, I think you gotta do you.
Yeah. Last one that I want to mention, it can be challenging to determine the value of these policies. So how do you determine what's a good deal for a life settlement policy? It isn't exactly cut and dry. Right. So there's a lot of dependence on the math, which we gave you a lot today, and probability. But death, while certain, isn't, entirely predictable.
Yeah, so, exactly.
And that brings us to the end of this episode, the death of this episode, as you will. Now, you're right.
A moment of silence.
A moment of silence. Now we know how life settlements can turn life's one guarantee into potential investments, opportunity for the right person. Again, do what's right for you. Yeah. And as the industry actually matures, it offers an innovative way to unlock value from life insurance and diversify your portfolio. And again,
exactly.
When you're investing, that's kind of the one thing, diversification, right?
Yeah, diversification is great. And we're not here to tell you what to do. We're just here to expose you to lots of different potential investments that might pique your interest. Whether you are considering selling a policy or you no longer need it, or you are simply like fascinated with this potential investment opportunity and how certainty and creativity cross paths in finance. Understanding the mechanics, the facts, and the risks behind life settlements is essential before dipping your toe into that water. Yeah. But thank you so much for tuning in today, and we will see you on the next episode.
Thanks for joining us. Stay tuned for more insight on our next episode.
And don't forget to subscribe to continue the Alternative Investments chat. See you next time.
Content provided in this podcast is for informational purposes only and should not be construed as professional, financial, or investment advice. This podcast should not be construed as an offer to sell or a solicitation of any offer to buy any securities. We strongly recommend that you seek advice from a qualified professional before making any financial decisions.